Hello, this is Mike Swanson of WallStreetWindow.com. I got a very special guest with me today. I'm speaking with David Skarica, runs the website addictedtoprofits.net. How you doing today, Dave?
Good, Mike. How you doing?
Oh, I'm doing good. Well, we got a long weekend and the market's closed on Monday, so people have time to rest up and get ready for this coming week. What are you looking at in the markets now? I don't think we've done an interview this year yet, so here we are for the first interview of 2019.
Yeah, I think we did one for my site, but we haven't done one, for your site. But yeah, I've actually been kind of stepped away from the markets for a few weeks. I was really bearish in the fourth quarter last year, and obviously we saw one of the worst, if not the worst, December in the markets, at least since the Great Depression, maybe ever. So in the U.S. market. So after that, we've seen this kind of ferocious rally back. The S&P's almost back to like 2750 or so. So the question is this just a bear market rally, or is this just is this a bear market rally, or is this a start of a new bull market, or the whatnot? What we are now is in a transition phase, and we kind of saw this in the summer of 2000, or if this is a bear market, or the fall of 2007. And what happened then was you had these initial kind of corrections or drops off the high at the start of the bear market. You go look at the spring of 2000 or the summer of 2007, and then the Fed kind of reverses course. Like the Fed did their last rate hike, I think it was June of 2000, and it was actually 2006 when they did their last rate hike then, but they started cutting rates in August of 2007. And then the market kind of sees this reflex rally on the hopes that, this loosening monetary policy is going to help the economy and help the markets. And then usually at some point that rally fails. And in the case of 2007, the rally actually went to a new high, but there were so many stocks lagging. And you can kind of see, I don't know if that's going to happen, but you can kind of see, I could see that happening because we've seen the market rally so much from its lows. And now it's being driven by even fewer and fewer stocks. Like the FANG stocks are all lagging, and you have a lot of these big aerospace companies like TDG and Boeing, and these kind of companies are really the leadership. So you're seeing this like less and less stocks driving the market, even less so than was last fall. So I don't know if it's going to make a new high, but I do think the way it's trading, we're not going to see a rally lower. Right, decline lower right away, a retest of the lows, within the next month or two. I think more than likely what would happen is either this rally would continue, you might see that kind of non-confirmation high, or you might just see the market top out for the next few months and then kind of roll over maybe into the summer and into the fall after that. That's something kind of what happened actually, by the way, after in the early 2001. The market kind of topped out over the first half of 2001, and then rolled over into the fall.
Well, right after the bottom in December, I saw Jim Cramer on CNBC declare that we had a bear market because the market fell 20%, and now we're in a completely brand new bull market, and he's very bullish on the market right now. I mean, making it sound like it's just going to go up forever. But one thing, in a certain sense, it doesn't matter because most American investors, they're in the FANG stocks, Apple, Amazon, Google, and these stocks are just lagging. So even if we're in a new bull market, these are laggard stocks, and they're going to not make as much money even if the market goes up. So I think even if people are bullish, that most people need to make changes if they want to do well. And you mentioned those past cycles, gold came alive, and gold's outperforming so far since October. So do you think that's a real trend in gold or a blip, or do you think I think people should get out of these FANGs and into gold, but what are your views on it?
Well, the thing is too, I know a lot of people paint you as a gold bug and they talk about poor gold is done, but you have to look at where it is right now. Remember, when I started out 20 years ago in the late 90s, we were in a very similar situation to where we were now, where we had these bubbles in these tech stocks, and back then it was the dot-coms, and there was really no name, the Nifty 50 in the 70s for it, but you had these mega kind of telecom and tech stocks, like Cisco, Lucent, WorldCom, et cetera, Microsoft, et cetera, right, back then. So it was the same thing. You had people all in those stocks, like Sun Microsystems was another one. And the thing was, even in 2000, when the market held up until most of the year, until, August, September, most people were losing money because those big tech stocks were starting to blow up and starting to fall. So that's kind of like you just said is happening now, is that you can say, like I said, even let's say just for argument's sake, the market, the S&P did hit a new high. Well, that new high is going to be driven by aerospace stocks, maybe defensive sectors like healthcare, which most people don't actually own. Maybe their pension plans own them, but the actual average individual, like you said, they're all in the FANG stocks and these kind of hot sectors. So I would say, yeah, and again, if you look at it, again, like the early 2000s, you're now seeing, it's not just like gold bugs, like Peter Schiff always warning that the doom and gloom and everything's going to blow up. It's like you're actually seeing the technical action in the gold stocks act well. We're seeing the GDX and GDXA act strongly. We're seeing gold hold up over 1,300 for a number of weeks. And I think that 1,350 to 1,375 area, which essentially were the tops of all these gold rallies going back to 2013, when that breaks, we'll have a massive 5 to 6 year base going on, and the gold and gold stocks can really start to move when that happens. So, I think that it's more the technical strength you're seeing in the gold stocks is why you want to be in them.
Yeah, to me, you mentioned Cisco, and to me, like a stock like Apple makes me think of Cisco, because back in the 90s, Cisco was one of the most-owned stocks, along with Oracle. And then after the market, the tech top of 2000, the Dow held in there for a couple of years, but Cisco just lagged forever. I mean, over 10 years, Cisco was a laggard. Even after the stock market bottomed in 2003 and went up, Cisco barely went up. And to me, that's like Apple now. Everyone owns it, like they all own Cisco. And I think there's ways to make money now besides that one stock. I mean,
and I think too is if you go look at like Amazon, even for example, even as
yeah.
well as Amazon in the last 20 years, it didn't really significantly break through its 1999, 2000 top until about 2010, 2011. It got near that top at the top of the markets in 07, and then it fell 65% during the bear market in 08 and 09, and then Amazon, didn't break out to about 2010, 2011. So even that stock really took 10 or 11 years to play out. And that's what it looks like in a lot of these companies. And then the thing is, so you're talking about Amazon, you're talking about Cisco. Amazon is like the premier one, right? That's the one that ultimately went way above those highs in 99. Like Microsoft, even though it's gone way above recently, it didn't do it till like 2014 or something like that, 2015. And then a lot of these stocks, you're talking like Cisco and Oracle, they really haven't gone much above the 2000 highs. And then you got stocks like, for example, like BlackBerry, which will never see those highs again. So that's the problem with thinking, Apple's always going to go higher. Well, the problem is, no, you have these secular kind of tops in these companies, and it does look like, if you take into account Apple's share of the cell phone market, the fact that it's really a one product company now, it's totally dependent on the iPhone. That it does look like we might be entering some kind of secular top, for that company. So that's another problem too. And like you said, people always, again, when you're at a bottom in a sector, they always laugh at you for being long that sector because it's done poorly. But you would have been better off in the early 2000s for the next 10 years actually being in gold and precious metal stocks than, like you said, owning all those old leadership tech companies, right? So that's kind of where we are now. We got a lot of these beaten up gold and precious metal stocks, and I think that is exactly where you want to be. And like, for example, a company that just had poor earnings, which I own, called New Gold, they basically said that for their mine to be profitable, they need gold to go over $1,500. In a nutshell, that's what they said in the last earnings report. Well, that's the kind of stock, it's like $1 a share. That's the kind of stock that will be really, really leveraged if gold can get above 14 and then 1,500, because then all of a sudden they go from being uneconomic to being profitable. And that's where your leverage comes in these companies. So, and you saw that in the early 2000s, but back then it was like more like 400 to 500 the companies needed. And when it went through that, you had all these stocks that were like penny stocks, were beaten up, because they they couldn't make money at 300 gold. Then all of a sudden, and Eldorado was one. Eldorado, this is before they did their reverse split recently. It was like a penny stock. It was like 20, 30 cents, and then ultimately went to $20 over the next 10 years after that. So that's the kind of opportunities you're going to see in these companies. And again, the problem is because you have so many gold bugs and gold bulls, when you say this for a number of years, they're all like, oh, whatever. But let me tell you something. Again, I started 20 years ago. I started in 1998, so I started 21 years ago. And I was buying the gold stocks at 98, 99, and I had to wait a year or two. But when they started to go up, like I said, companies like Eldorado and Yamana, these companies all went up 5, 10-fold. And that's kind of where we are now, that even if you've been buying gold stocks for the last couple of years and you're just sitting there waiting for them to turn around, it's worth the rate, even if you missed out on some of the blow off in those FANG stocks, because the type of gains you're going to see from the bottom of the cycle are way bigger than you're going to see in late cycle gains in the equity markets.
Well, you mentioned in the 1350 to 1370 level on gold, and it does appear like, you know, we saw 2 years ago in 2016, those levels were attacked. And during the weeks into that move, many of these small cap mining stocks really doubled, went up very quickly, and then, you know, it was just a short-lived move because we didn't go much higher than that. But it makes me think that if we go through those levels again, we'll start to see these small cap stocks just explode across the board. Now, last week I was talking with Jordan Roy Byrne, and he was saying he thinks basically the Fed Reserve, when they lower rates, gold will take off. Now, I think the market may anticipate that before it happens. But what are your views on the timing? I mean, it's really impossible to exactly predict it. But what's your feeling about the timing of when it could when gold could go through that?
If you kind of look at it in 2007, that's what happened then. I know gold stocks crashed with the market in 2008, but until that summer of 2008, gold stocks were essentially the best performing sector from about the summer of 2007 and summer of 2008 as the Fed lowered rates during the early part of that recession and the financial crisis. And then in 2001, they raised rates cut rates in January. And when they cut rates then, the gold stocks actually bottomed in November, December of 2000. And then it began to move higher. We're in a little bit of a different situation here because the gold stocks actually bottomed in 2016. And even though it doesn't feel like it because they did nothing throughout the second half of 2016 until really the end of 2018, they've kind of almost had like an 18-month consolidation after, you know, actually, sorry, like a 30-month consolidation after that first move in 2016. And I think we're starting that secondary leg higher. And yeah, I agree with you. I think they're going to start sensing that they're going to do that. And I think what compounds this, and the reason the gold stocks, I think, will act stronger before and anticipate that first rate cut is we didn't have the debt and deficit problem in 2000 or even 2007, 2008. Remember, the deficit blew up after the financial crisis in 2008. It was not that bad in 06, 07. So we didn't have the debt and deficit problem that we have now. So you got them cutting rates plus the federal government running an over $1 trillion deficit probably for fiscal 19. And this is all happening at a time when maybe the economy might be rolling over and them cutting rates. I think that is why you'll see an explosive move in gold and gold stocks, because on top of anticipating the Fed cutting rates, you're also going to get this defensive play where people are going to be buying it because the debt and the deficit are blowing up. And then if you take into account, again, you already got this $1 trillion deficit at the top of the economic cycle, that's going to blow up. And then if you're even looking, you're talking about gold anticipating, well, if you look at like what's happened politically with both parties becoming more kind of polarized, you've kind of got these these borrow and spend populist Republicans, and then you've now got this huge tax and spend socialist element of the Democratic Party really kind of taking over the party. I think gold will start anticipating that, hey, you know what, these deficits aren't going to go away anytime soon in like 2020, 2021. They'll probably get worse after the next election. So I think all those things, cutting rates, we're going politically, the debt and deficit, mean that gold is going to start anticipate that. And by the way, central banks all over the world, they bought gold at like the fastest rate since like 1971 or something. last year. So I think a lot of people are kind of anticipating this. And like I said, if you're not just looking at the fundamentals, not just being kind of a gold bug who's always calling for gold to go up and always calling for the world to collapse, if you just go look of where we are, technically, yeah, if that 1375 to 1400 level goes on gold, that's a massive 5 to 6 year base. And once you get that kind of base, the old saying is that the bigger the space, meaning after a 5, 6 year base like that, I wouldn't be surprised if we're entering another 5 to 10 year bull market.
Yeah, that's the key. I mean, that's why this is such a fascinating moment. We've gone up to that key resistance level, and it's a really a trigger ready to get fired, and I don't know how many people are even watching it. You know, I fear that most people are completely asleep on what's happening.
Yeah, no, I agree with you 100%. I just think that, and the thing is, most people just like to chase, right? Like, remember crypto late last year, and, me and you do some things in the marijuana sector, but, now marijuana stocks are the hot things. If you go look at the Google search results for cannabis stocks, it's exploded, because those stocks have been hot. So people just love to chase, but the way you really make money, in my experience, is you buy an undervalued asset, and even if you've got to wait a year, 2 years, 3 years, for it to pan out, you can have 500, 1,000% gains, and that's better than almost anything you're going to get at the end of a bubble. But the problem is a lot of people just don't have the patience to sit there. Like, for example, there's nothing to do with gold and precious metals, but one of the sectors I've been picking away at in our newsletter are the 3D printers. And a stock like SSYS, which we own in the newsletter, Stratasys, this stock has really done well. It's at a 52-week high, and the reason, frankly, one of the reasons I was buying that sector is because it's so cheap. These stocks had their bubble in 2014. They've been in a 5-year bear market. A lot of them are off 80 to 90% from their all-time highs, and this stock has essentially doubled off its lows in the last few months. But again, you had to wait for years. You could have bought Stratasys at $20 a couple of years ago. It's 28 right now, and just sat there and waited and waited and waited. Now, boom! All of a sudden, you got a 40 to 50% gain on the company. So that's kind of what you got to do. But a lot of people just don't have the patience to do that. They just want to chase and this sort of thing. And my advice is, if you're in a hot sector, and a lot of people can't do this because they're not accredited, or it's difficult to do this, is that Mike and I do these kind of pre-IPO private placements. And the advantage of doing that is, okay, your money's locked up for 6 months, 12 months, something like that before the stock trades, is that you're buying the stock at a relatively half-decent valuation. Like, for example, you might be buying the stock when they're valuing it at 10 million, and then in a bubble, when these weed stocks are worth hundreds and hundreds of millions, it will come public at that. So at least you're not buying it like that and just kind of buying high to sell higher. You're buying it at a half-decent valuation and then hoping that bull market continues, and then getting the leverage when the company starts trading. So that's kind of the way I do play it if I am in a hot sector. But for the most part, I prefer to buy assets that are undervalued. And I know I've seen it in my account recently, like a few weeks ago, Eldorado, which I mentioned earlier in the last bull market, that stock was up 27% in one day, and some good news, because the stock is so up and cheap. And you're not going to see stocks, for the most part, unless it's a takeover or something, move 20, 30% in a day near the, in the latter stages of the bull market. It's much easier for a stock to do that coming off its lows than they are coming off its highs, or at its highs, sorry.
Oh, for sure. Well, I know I've taken up quite a bit of your time, so I'll let you go. And anyone listening, check out your website, addictedtoprofits.net. And what do you provide people in your trading service?
So we have a watch list. Like, for example, the Stratasys is on our recommended. We have 2 levels of service, by the way, just to quickly start here. We've got a platinum, which is more in-depth, more trading updates, option trading, this sort of thing. And then we also have a basics and more stock recommendations. And then we have a silver service, which is our basic, has a handful of about a dozen stocks, about a half dozen option and short positions. And we just, so we have recommendations. We also do podcasts like this where I explain the macro markets and do video overviews. And we have special updates on sectors from time to time. I kind of got rid of the basic monthly letter because I prefer to do these like kind of weekly updates and podcasts and video updates. I think they're kind of more timely and more useful for the average investment. But when I do see something special out there, I will write a special report. Like we just did a report on subprime auto and kind of the short opportunities we see in that sector because I feel that bubble is starting to burst. So we do things of that nature. So, and the silver is $70 a month and the platinum is $200 a month. But right now we're having a special where we'll sell the platinum and not only that, sell a lifetime service to the platinum via either wire or PayPal for $1,500. So, to get a $2,400 service lifetime for $1,500 one time is a pretty good deal. I don't know how much longer I'm going to let that last, but I'll probably let it last, till the end of February or something like that at least.
Oh, great. Well, people should certainly take advantage of that. And thank you for taking the time to talk with me and everyone out there.
Yeah, thanks for having me.